Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, December 7th, 2020. We're going to look at the broad markets, and I'm going to cover a few things that I haven't highlighted recently. Time permitting, I may do an update on gold. That still looks good and continues to rise, so that's where I think one of the better opportunities lies. But I want to really, I'm upping my analysis and frequency of updates on the broad market. As I said recently, the trend is bullish, make no mistake about it. No sell signals yet, but we are seeing more and more extremes, more and more, you can call them maybe not red flags, yellow flags. In some cases they are red flags, some of my indicators. And that's what I want to talk about. It's really sentiment as well as this one. I won't spend a lot of time here because I put out a post on the front page this morning with this chart here, as well as the NASDAQ 100. And what I'm talking about are my low volume sell signals. Indicators, really don't get any more simple than this. But as I said, made it very clear on there, this indicator is not an exact timing indicator. What you use this, it's similar to divergences and overbought conditions. Those I talk about all the time. Positive divergences are not a buy signal, negative divergences are not a sell signal. They can continue to build. Sometimes they get burned through and never play out. Just like overbought. If you try to short a stock in an overbought market, let's say you went back to 1999 and tried to short .com stocks, in the early 1999 when it was clear we were in a bubble, you were broke by the end of, before the bubble burst in March of 2000. So you can't short a stock just because it's overbought. You can't buy a stock just because it's oversold. But what you can do is take those and other factors and then wait for buy signals that tell you to either exit your longs or get into shorts, or in the case of bearish extremes, they tell you to go long. So the way I view, what I'm really building towards here, in the last, months now, we've been in a trading range, multi-month trading range, and I've been mostly focused on short-term trading opportunities, whether it was very short-term active trading, day trades, 1, 2, 3, 4 day, very quick swing trades, or maybe trend trades when we broke out of some of those, we put in a divergent low on the 60-minute chart recently. And so I've really focused on short-term trading and even short-term swing trading. But now what I'm building towards is the next tradable trend. Now the trend right now is bullish, and it may continue for some time, but I'm going to point out a few other things that I haven't recently, and I'm just going to recap again that whole front page post today about the low volume sell signal. Okay, so as I mentioned, I have two variations of this chart, but they're around the same level. And down here on the bottom, what you're looking at is the S&P 500 up top, and then just the volume. Those are the light bars there, but I like to smooth it out because if you try to take 1 day, anytime you use a volume indicator, you're going to get those 1 day drops. You're going to get them around Thanksgiving holidays, abbreviated trading sessions, things like that, what that does is you smooth out by using a 10-day average. And I like the exponential moving average. It moves a little faster than a simple moving average. And so that's it. As I said today, we have our first drop. We hit that red line and cross all the way down. We're almost to that yellow line there. Last time we did that was right here. And as I said, sometimes you get those sell signals, and they can stay low for a while. Volume can stay low. But what I'm going to do in this video is something I didn't share in that post this morning. What helps, let me just circle them all. Here was a period of extended low volume. There was another period, and these were all, I think, circled today. Extended low volume there and extended low volume there. Okay, so what helps is to identify these periods where volume does drop to these extremes. And because it can either be relatively quick, like in this case, if I take the line up, you can see the correction started right after that. Nice tradable correction, even for a swing trader. This one, it didn't take too long, and then you had, again, one of the bigger drops in a while. Or in these cases, it did last a while, especially that last one leading up to the COVID lows. Again, I've said it time and time again, there was a tremendous amount of technicals, including the sell signal we got here. So it was no surprise, this correction. And the magnitude of it was certainly exacerbated by the shutdown. But again, there were numerous things in place leading up to that drop that indicated a trend change or correction in the market. Okay, so where I'm going with this is, Now, with a few exceptions, you got a spike back here. I'm going to show you what I'm going at here. Let me put on my arrow tool. There was a little spike here, but what you want to see, and you did get a little correction on that spike, but what you want to see when you get locked in these periods of extended volatile or low volume, it's usually once you break back above the lines, that's where it comes. So again, I circled here, we started, hit the red line here, actually crossed down below it, hit the yellow line, but right here is where we cross back above. And why that is because typically, almost always, and I think in just about every instance, during a correction in the stock market, volume will increase. And so that's a tip. Now, sometimes it's one and done. I have seen cases, and here's an example where you had almost a one and done reading and the correction came right away. So where I'm going with this is on this indicator alone, it's just a heads up right now that a correction could start today, tomorrow, or it could be weeks from now. So what we will look out for, what I'll be looking out for, are sell signals such as breakdowns on those 60-minute trend lines I gave you today on the S&P 500 E-mini futures and the NASDAQ 100 E-mini futures. A little bit longer term, as I mentioned today, there's trend lines on the S&P 500, or more so, even better on the tech-heavy QQQ right here. That's not it. This is it. Right there is an uptrend line. So that would be one potential sell signal there. Maybe a bearish engulfing or any other type of bearish candlestick reversal pattern. So there's many forms that a sell signal can come in, and the more sell signals we have, the more indexes that break down, the better the chance of it's going to lead to a meaningful, in other words, a tradable correction. And right now, like I said, those early sell signals may come on a break of the 60-minute charts right here. Nice, pretty clean uptrend line forming on the NASDAQ 100 futures with negative divergences that have been and continue to build. So that's what we're waiting for. And let's get back to the low volume indicators, and we'll move on to a few things that I haven't covered yet. Okay, so here's those low volume indicators on QQQ. Same chart posted this morning, and you can see here red means you hit that red line. There was a correction. I made a little note here, following a correction, especially a big one, that washes out a lot of excess bullishness, and shorts aren't going to, they've already covered. They're going to wait till a better time to re-engage. So sometimes you'll get another drop in volume, and that's just a little side note. We didn't fully hit the red line, but I said post major correction. In other words, once you get the low volume sell signals, you want to wait. The big corrections, the big ones come after you've had an extended rally. Now, there were little corrections along the way. All those arrows show those. So you hit it, and this is where you had that extended period. Really from that tag of the yellow line right here, we had that extended period. But what tends to happen is the more extended this sell signal gets, or this persistent low volume, usually the bigger the drop. And so now in this case, we haven't had a tag to this level in a long time, and we're very extended. So I just want to point those out, take them for what they're worth, and again, use them in conjunction with other technicals, other signs that we may be poised for a correction, such as I've covered extensively in recent weeks here, the put to call ratio extremes. We recently had an extreme bullish or bearish reading, a bullish reading on the AAII. Now, by bullish reading, excessive bullish sentiment, again, they're contrary indicators, just like the put to call ratios. When the market is excessively bullish, then that's where you usually get the big drops, just like when it's excessively bearish. Think back to the meltdown in 2000, earlier this year, in the March lows. Everybody thought the world was going to come to an end. COVID was the end of humanity. Businesses would never open up, and that's when you wanted to buy. That's when it looked like the sky was falling, and bearishness was excessive at that point. But that was a time to step in and buy, and of course the Fed helped to juice things up. But again, looking at the indicators, remember, sentiment is a contrary indicator. This low volume is not a contrary indicator. It's just showing you what's going on under the hood. Now, the markets are drifting higher with fewer and fewer people buying stocks. And I take that as a combination of just that. But more so, remember, the stock market simply moves up on supply and demand. It's that easy. It's that simple. It's economics 101 that you took in high school. And that says if if demand outstrips supply, then your prices will go up, and that's what happens. Demand is buying. So when you have more buyers in a stock or the stock market, it's going to go higher. When you have more sellers, it's going to go lower. So it's been drifting higher, but on dangerously low volume now, and that's also a sign there usually that the short sellers have capitulated. They've given up as well because they add to volume, and you're just not seeing that now. So okay, so that's that. Let's move on to a few other things that I haven't showed you yet that stand out to me. Here's one worth noting. This was a recent article in Bloomberg. Citi flashes warning on S&P 500 overshoot rally, taking stock, and basically said, record-setting November for the S&P 500 index. Blah blah blah. We know what's been going on. Markets at new highs, but one of the Citigroup sentiment indicators recently also triggered extreme bullishness. The reading of panic versus euphoria rose to 1.10 from 0.07 over the weekend, in the sign that investor exuberance may start fading soon. In other words, the last time this indicator, and I'll scroll down and show you it, was this high was in August, just before the market dropped 9.4%. NASDAQ, remember, fell much more than that. I think it was about 14%, the NASDAQ 100. So that's it. And you probably can't make it out here. Let me see if I can expand this. I think I can make it a little bit larger for you since you're looking at a video. But there it is. So there was an August peak. Again, hard to see on here. There's right there, and that's where we're at again. Now you can see, just to put it in perspective here, what they didn't, I don't think they mentioned in the article, this was 2007. Here was the top right there in the end of the last big, bear market before the Great Recession, before the S&P 500 fell 55% in one of the worst bear markets ever. And we're only at that level. So that's their euphoria line right there, this blue line here, and there's their panic line. So you pretty much want to buy on these panics, and you want to sell on euphoria. And nothing really compares so far to the great dot-com bubble back in the 2000s, for those of you that were around and remember that one. So basically, other than 2000, we're at all-time highs. Other than that one there, well above where we were back when the last bull market ended. And just want to say, so can this go higher? Yes, this tells us that can go higher, and we know that there's absolutely no ceiling on this indicator. But unlikely we're going to see those levels again, in my opinion. But again, just something I wanted to point out. Okay, so I spent a lot of time lately talking about some of the extremes that we're starting to reach, and make no mistake about it, trend is up. There's nothing wrong with being long. It's like I always say, like a game of musical chairs. There's a lot of money to be made in a rally, and just about anything with a ticker has been going up lately. So there's nothing wrong with being or staying long. It just means each and every day as these extremes go higher, the risk reward, the profit potential is smaller and smaller, and the downside is the bigger an extreme. That's where your big market moves come from, your big reversals, when things get too out of whack, when a rally gets too overdone. Stocks, especially low quality stocks, are bid up without any regards to the fundamental. Just it's, they call it, and you can look up this term, the greater fool theory in investing, and that is, buy a stock at a price with the intent to sell it to somebody else at a higher price, someone who will be a greater fool and come in and buy it. And that works great until it doesn't work. Let's look at this. So what I did here is, this is Google Trends. You can go to Google Trends and type in any term, and it's going to show you how that term has trended. Data goes back in most cases to about 2004, so that's where I ran it here. And what I did first, and we'll go over just a few terms. I'm not going to spend a lot. Just simple term stock trading. I'm trying to put my head, and this is kind of playing into that whole, use the example, from Joseph Kennedy about the shoe shine boy example back in, just before the crash of 29, and how that was his time to get out of the market, out of his longs, and start selling going short. And what you can see here is, again, going back to '04, we've never ever seen a spike. This is the highest that term has reached. And what they do is, you can again go to Google Terms, click on it. It's going to tell you 100 is the relative high point of those search terms. And again, so what's 100%? So that is it. And more so, we've never even seen anything remotely close to the surge. And this is all recent. You can put the little bubble here, and that says right around the end of December, we were low. All of a sudden, into the March lows, that's where everybody and their brother, and think about it, you're not going to have professional stock traders. This is what I'm going to talk on here. And again, these are common terms in the market, and they're not to be offense to anybody. Technically speaking, not a professional stock trader because I trade for my own account. I mean, it is, and it's what I do for a living, but I don't trade other people's money. And where I'm referring to is they call the smart money those that do that. Professional mutual fund hedge manager, or mutual fund managers, hedge fund managers, and other professionals that trade other people's money for a living, and they're called the smart money. And then the retail crowd, and that is, those that open brokerage accounts and just have another job and trade for fun or on the side, they're considered the dumb money because they tend to buy in at peaks on market tops. They tend to panic out at market bottoms, and often trade contrary to how they should be trading. All right, so with that being said, again, I'm going to lump myself in the dumb money category because I don't want it to be offensive, but I just have to use those terms. And the point I'm trying to make here is, when you look at these search terms, you're not going to have a 20-year-old seasoned money manager Googling the term stock trading. And so this tells me that, and I know it from all the, I listed a few first-hand examples just a week or so ago in a video, and I've read about it extensively lately. Everybody and their brother, people that have no experience in the market, are trading money, trading stocks, and making a lot of money now because they're buying just about anything with a ticker. They're buying, Tesla and even any automaker that has promise of electric cars, really without regards to the fundamentals and paying attention to the valuations on those stocks. Are you buying it only because it's an electric car, or are you buying it because the growth prospects over the next year or so are promising? Now, this is interest over time. I already covered that. Let's skip by, it doesn't matter, interest by sub-region. But what I wanted to look here, related topics. So this is what Google is showing as the related topics when people hit that term. Mobile app. Okay, so I can tell you right now, professional traders, again, I trade for a living. I don't trade on my phone. Anybody that's trading on their phone is I'm not going to say they're not serious about doing this, but they're not putting in the time and the effort that it requires to do this and make money over time. Again, all ships are lifting a rising tide. I'll go back to that saying, and it's been around forever. And that means in a bull market, when you have a broad-based rally, especially a speculative fueled rally like we've had recently with the Fed being in the market, like we had back during the dot-com bubble, all ships are lifting a rising tide. Says just about every stock goes up. So it's when the tide goes out, that's when you see that'll separate the professionals from the retail crowd. Robinhood. Okay. Robinhood is the epitome of really what's going on today. Robinhood, most of you probably know, and I'm sure a lot of people have a Robinhood account, unless anything's changed. I know when it first came out, it was a web-based only, an app, a mobile phone app for stock trading. I don't believe you could log in and do it on the computer. Maybe that's changed. I haven't looked into it, but that's the epitome of the the type of trader. And again, I'm going to show you. We'll Google that term, and you'll see a comparable surge in Robinhood. Google searches for the company Robinhood. And again, what does that tell you? It tells you that I give you my word that these hedge fund managers and professional money managers managing billions of dollars are not doing it while they're out at the Hamptons on their Robinhood app. They're in the office. They're glued to multiple monitors. They're doing their due diligence, and so it's kind of indicative of what's in this market right now. And that's, again, it's hot money, people, penny stocks. Another thing that the pros aren't trading. And then that's it. And then when you go here, you'll see a lot of, on these searches, related searches, a lot of retail brokerage firms. That's the other thing. Fidelity, Robinhood, Ameritrade, Schwab, they cater to the retail investor, not the professional investor here. Let's do this. Let's do Robinhood and look at related terms. And you go down here and you're going to see stock, topic, mobile app, trader financing, investment. These are the words that, the terms, related terms they're looking for. But when and there's the look at that. That's Robinhood search term. There's Robinhood company. It's going to look the same. Not many people are searching for Robinhood, the legend from way back when. This is the again, the search is just for the company, and it's gone explosive. This is it. Remember, the company didn't exist back here, so don't even pay attention to that. You can look at the last, we can go last 5 years, and again, you can see just a tremendous interest. But what I did notice is a peak in interest, a declining interest. Here's the peaks. So fewer and fewer retail investors are jumping on that train right now, and that is also aligns with what I started this video with, the decline in volume. So you had when the sky was falling back in March. This is where that big surge was, and throughout the way we've had some corrections. You've had spikes in it, but you have a clear waning in interest for people Googling, looking for Robinhood, learning up about it, going to the website and searching for it. So this also tells me that that retail crowd that have driven up a lot of the stocks and the market up to this point, that interest is waning. It's no longer growing. Here, now that I'm zeroed in, last time I had the search term Robinhood. This is for the company Robinhood, and there's the same thing. Crypto, Webull, cash management, pattern day trader. They are probably getting hit with pattern day trader notifications. That just means if you don't have 25,000 or more, I think it is, in an account, and you're trade too many times without a margin account, your account's going to get flagged. It's an SEC regulation, and it'll be locked if you do it again. So these are all terms that newbies are searching for. Again, just kind of shows where the market's going. Now, on that, just to kind of help solidify, I've had an account for years, and most professionals that do this, whether it's their own money or others, a lot of them use Interactive Brokers. The minimums are a lot higher. You have to have a certain amount of trades each month, or you get hit with some fees. But if you do a lot of active trading, the fees are a lot lower. And there's other reasons that the professionals go there. They don't sell your data like a lot of. That's how Robinhood and those companies make money. That's how they can do free commissions, is by turning around and selling your order flow to those firms that you heard about that jump in front of it, high frequency trading and all that good stuff. And you can see here, there's been a spike, but nothing near what it's been here. Let's go back as we need to, longer term, and you can see we're not at anywhere near the all-time highs in searches. So what this tells me is those that are professionals, yeah, there's been a surge, but again, nothing off the norm of what we've seen here before, and well off the highs. So this is nothing close to what we've seen on the search for terms like stock trading, day trading, and of course Robinhood. So there it is. I'm just trying to again explain what the underworkings, or at least my interpretation of what's going on right now in the market. And those are short-term, it's short-term bullish when you have a lot of retail traders like that in the market. But as soon as this ship finally turns, they're going to run for the lights. And a lot of them aren't going to realize it until they've already lost most or all of what they made. That's how these bubbles work. The speculative bubbles, where dip buying works. Those traders get conditioned like Pavlov's dogs. Every time the bell rings, they salivate, buy the dip. It works, and all of a sudden they buy down. Didn't work. Drops more, buy more, boom. And there's, after the market's corrected 30-40%, they've, and those high flying stocks are, and those are the ones that will drop 50% or more. So that's kind of the conditions underlying the market right now. And yes, I just spent 20 minutes talking the bearish talk, but again, Timing is everything, so we'll wait and try to get our, wait for some solid sell signals. So if you're long, you want to continue to play the trend, great. Just don't stay too late to the party. Okay, we'll move on and wrap this video up. So that's it on right now, very near term 60-minute chart NQ. That's the line you want to watch, I think, at this point in time, along with, when sometimes you get a breakdown in the NASDAQ 100, but not the S&P 500. You want to see both. You have a comparable uptrend line there, but it's a lot lower on ES, the S&P 500. So I have this minor trend line, not as significant as a larger trend line, but certainly worth watching. And then again, the common traits are we have these divergences that set the stage for a trend reversal. So all we need now, there's a lot of ingredients in there. You just need that catalyst, that spark, which is a sell signal. And although that trend line on the NASDAQ 100 or QQQ daily chart is quite a bit lower. Remember, we're going to break the 60-minute trend line first. If we zoomed in, here's my daily chart of QQQ. But if we zoomed in tight, that would be that minor trend line I was giving you on NQ right there. We can probably see it here on, yeah, there it is on QQQ. Here's my QQQ 60-minute. Let me sharpen it up a little bit, tighten it up, catch those candles there. Yeah, that's it. Nice and clean. Forget about all these other lines. I'd have to update it and see if there's still significant support and resistance levels. But this is the line right here that I'm watching if you want to replicate on QQQ. And I believe once that goes with conviction, that should start the spark the rally. So we could be close. Now, the million-dollar question, is it going to spark the rally, or I'm sorry, is it going to spark the big correction that all these extremes are pricing in or saying is likely, or just a minor correction before another thrust to new highs? I don't know, but that is certainly possible. We'll have to see how the charts develop if and when that starts to happen, and I will provide frequent updates. One thing I will say, if you're of the same mindset I am, that this is getting a little bit ridiculous, that the risk to the market right now and the potential upsides, if you believe they're equal or unilateral, then it's 50-50. If you think the risks are skewed to the downside, in other words, that all the rosiest optimistic scenarios have been priced in already, mostly or fully priced in, that leaves a lot more downside should things start to go bad. Should the stimulus package it's trying to be pushed through now not materialize, or not materialize enough to please the market, should Fed see something that they haven't seen, which I've been harping on for a while. Inflation is here and it's real. Of course, there's a lot of people that say the government understates or misrepresents inflation. That's been the Fed's one the big thing that's allowed them to keep us at the floor on interest rates. But I've showed you how commodities have significantly moved higher. Food, agriculture commodities, which, food and housing, those are two of your biggest costs or inputs to the consumer price index, inflation. And we know housing has been really hot, especially since Fed took rates to the floor. Housing market's been very strong. Rents have been very high. In some areas, you go to markets like Miami, that's where I'm originally from. The real estate market is insane right now, insanely high and unaffordable. There's many metrics that say, well, prices can be high, but they can be affordable based on salaries and incomes, and that's not the case. And a lot of other markets. So that's all I'm trying to get at, guys, is that these are some of the potential risks to the market. And if that happens, and all of a sudden the Fed starts backpedaling a little bit on their pledge to keep rates at the floor, because remember, they did that, which is, I thought, I don't want to use the word stupid, but I thought it was a bit careless to make that statement when they did a while back that they plan to keep rates low for, throughout the year, throughout 2021. Well, one thing I can tell you about the Fed, I've watched them for years. They are a reactive entity, not proactive. They'll say one thing and then they flip and turn on a dime when market conditions change. So, anyways, let's see. There could be something else, or hey, who knows? Maybe there's a bullish catalyst that sets the market for a big blow off top in 2021. I don't know, and that's why if we get these sell signals, here's where I'm going. If you believe that everything is gotten too far ahead of itself, and you want to go ahead and try to swing for the fences, meaning a much bigger drop, then if and when you get the sell signals, let it go. If you get profitable, you can lower your stops to entry and let it ride, trail it down. There's going to be kickback rallies along the way. That's if and when the next drop starts. And look, We're not far from it now, at least on QQQ. And again, for a short-term sell signal. So how does that work? So you get the short-term sell signal. You go short. Then if you're an active trader and you want to cover, you can cover on this trend line if that's your target for a quick pullback trade. If you are a longer term swing trader, you might want to hold, ride out any kickback rally. Like I said, keep your stops in place wherever you shorted and hold out for what could be a much larger drop based on everything that I've been talking about in this video, as well as other things here in recent weeks with sentiment indicators and all that also reaching extremes. All right, I think that's enough. I don't want to beat a dead horse. That's it. Like I said, when you have an uptrend, respect it, respect it, respect it, respect it, and wait, boom, for your sell signals. Wait, boom, for your sell signals. Like I said, stay long, or if you don't feel comfortable going long, then wait patiently for the short entry. For if and when it comes. And eventually you're going to get a sell signal. It's just a matter, does it come soon or down the road? Okay, we'll wrap it up here, and I'll do another update on gold. There's not a lot to change. Gold's up today, nice rally. The mining stocks are doing well, and I'll cover those. I've covered them quite a bit lately. There's no major technical developments today other than just a one-day rally. So we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.